Hello and a warm welcome to Econoday Unplugged on Wednesday, 22nd of June, 2021. Mark Pender's stateside, and I'm Jeremy Hawkins in London. So last week's FOMC announcement might not actually have done much to change the near-term US monetary policy outlook, but financial markets have certainly reacted to what might now be a somewhat sooner than expected tightening, with the updated projections pointing to a probable 2 rate hikes by the end of 2023. The June meeting provoked the fourth most negative reaction by 5-year treasuries since 2011, stock market sell-off and a sharply higher dollar. However, as the dust has settled, bond yields have fallen again, the 30-year even temporarily dipping below 2% for the first time since February yesterday. Spreads have narrowed dramatically and equities are rebounding. And crucially too, market-based inflation expectations have eased back to levels not seen since March. So it seems that the Fed has made a decent job of convincing investors that the rise in inflation will indeed be only transitory, while at the same time starting the ultimately inevitable shift towards a less accommodative stance. So Mark, clearly taper tantrums remain a risk further out. But for now, is it fair to say that the Fed ought to be at least cautiously content with financial markets' response?
I would say so. I think they did a good job. What they had intended to do, which was to, and that's a very difficult communication effort. This is a very subtle moment, of course. And they played the good cop, bad cop with the FOMC 18 members putting out a rate increase, a small rate increase, 2.5 years out into 2023. At the same time that the good cop, Jerome Powell, dismissed it, and just kind of almost said, as he's had in the past in the FOMC, either it's intentional or he's using it as a stick man, that you shouldn't really pay too much attention to the projections themselves. So they got away with that. Weekend was interesting. You had James Bullard, who's the president of the St. Louis Fed. He's always been, I don't want to say troublemaker, but I will, because he goes either, he can go either way. If the Fed is hawkish, then he'll make some dovish headlines. If they're dovish, then he'll make some hawkish headlines. And so at week's end, he even pulled that up one more into 2022. So, and he does rotate in. So that'll be interesting. We're going to get an interesting kind of mix, but all that inflation we've been talking about and we've been seeing and that Jerome Powell concedes has been greater than expected. At the same time, however, he also concedes that U.S. job recovery has been slower than expected. So that's an unwanted mix. There is this floating idea out there that rates may go higher a little bit sooner than expected, and rates, the conversation is around rates, but by extension, then that's a tapering issue as well.
Okay, well, since it's still all about inflation and so on, we got the PCE deflator out on Friday.
The PCE deflator, right? The personal consumption.
Yeah. So what are we looking for on that?
Let me just check my Econoday calendar here, and now this will be data for May. It's lagging data. It lags the CPI, which has already been out at mid-month. The Fed massages these numbers. Updates the basket and component adjustments more regularly. So this is their Bureau of Economic Analysis. This is their baby, as it were. And right now, the Econoday's consensus is 0.5% monthly gain overall, and that is quite a lot. That is quite a strong monthly gain, and that would compare with 0.6% in April. If you remove energy and food, it goes up for the core reading, which is really the central reading and the central gauge for the inflation outlook. Now, this is the PCE Corp price index, is 0.6 monthly gain, which is an exceptionally high gain. and that gain isn't related at all to the year ago, any year ago comparison. That comparison is strictly against April when it rose 0.7%. So that would be back to back. Now those readings exceeded expectations substantially in the prior month. So if that happens again, then there would be, I think a further adjustment in the markets that inflation is maybe a little bit too hot, and that's going to bring the rate move forward a little bit. However, none of this rate moving forward will happen if the employment situation doesn't really begin to accelerate at all. We're still many million, 7 million or so jobs short of where we were before the pandemic struck, and that's a huge, large amount of body of unemployed. And they're not going to be slowing down the economy unless inflation is like a double digits or really super out of hand. They have to, because there's so many factors in the market and in monetary policy that are favoring the rich against the poor, and if they started to raise rates with great damage to the lower wage worker, I think that would be something that there would be a red line there, I think, for Fed policy, especially at least based on their own rhetoric, the Fed's own rhetoric, which plays, it talks a great deal about the needs of the lower income and the disadvantages that they've been suffering during the pandemic.
So presume that's kind of it for the time being, but when we get to next FOMC, what's back end of July, isn't it, if I remember rightly, do you think sort of the idea of the Fed's going to start drip feeding the idea of look, tapering is going to happen at some point, and we're gradually starting to talk about it, this kind of idea, priming the pump, if you like, to get markets used to the idea?
If employment starts hitting expectations, payrolls have been significantly, either significantly or substantially below expectations the last 2 months. So if that fails to improve, and Jerome Powell at his press conference last week, he offered some reasons to be optimistic that the more vaccinations are going, those unemployed who are reluctant to take work because of concerns over COVID, which he says is a very substantial body, and then also, and that's related to childcare and COVID issues, that when schools reopen, and I guess the parents will be confident in the COVID restrictions in schools, that should also free up the unemployed to get more jobs or to take jobs. And also he talks about legitimately lead times in hiring, and that these, and he makes it he made the subtle point that these aren't people now who are going back to their old jobs. That's all long gone. That's all history. These are people now who are having to find new jobs, and that's a different thing, and that's a slower thing. So he sees reason for acceleration in job improvement. But if that doesn't happen, I think that you would be too soon, even if inflation is rising, it would be too soon to assume that a tapering would be in the cards.
Okay, roll on the June employment report. That's clearly going to be an interesting one. Okay, what about Europe then? Well, I guess sort of follow on from what's happening out the States last week. The ECB is going to be part happy and part not too happy. It's certainly going to be happy with the upswing we saw coming through in the dollar. As we've talked about on previous podcasts, the ECB has certainly been increasingly uncomfortable with euro levels. Well, before the last meeting, it was against the dollar, it's about 122. And I think generally people now are starting to take the view about 1.20 has been the ECB's pain threshold. Well, since the FOMC statement last week, we've seen euro dollar trading down below 1.19. So it's lost a couple of percentage points or so. It remains to be seen, of course, whether or not like it actually sustains that loss. But nonetheless, as far as the ECB is concerned, it's certainly going to be a good deal happier about that. However, it won't be happy with the backup we've had in Eurozone bond yields. Now, although we saw the initial sharp move higher in US Treasury yields, most of that's been given away. Indeed, as mentioned earlier in the intro, we've seen some fairly sharp declines over the last couple of days or so. But within Europe, by and large, we're still talking about yields being significantly higher than they were before the FOMC statement. So just looking at the benchmark 10-year Bund yield, on that climb from minus 0.23%, of course, we're talking quite big minuses for Europe, minus 0.23% for the FOMC meeting, up to minus 0.15% as we record this. That's a 4-week high, and it compares with the minus 0.31% we had. That was just before the March ECB meeting, when they announced that they'd be increasing their quantitative easing purchases under the PEP program, purely with a view to try to put some kind of lid on rising Eurozone bond yields. So, as things currently stand, it kind of certainly supports their decision of the last meeting to extend the current increase in PEP purchases to try and maintain some kind of lid on what's going on within the Eurozone bond market, because things currently stand, courtesy of the Fed, overall, I guess monetary conditions across the Eurozone are now rather tighter than they were certainly a week ago. Indeed, probably still somewhat tighter than the ECB would want in general during the course of the last several months. So it means then for the ECB that policy is still very much, it's going to be loose and it's going to stay loose for some time. Mark was talking about the importance of employment to how the Fed sees things. Much the same really applies to Europe, where they continue to take a very cautious view of the recovery here. I mean, the problem, as always, for the Eurozone data is that it does tend to be lagging. So most of the hard data really is just for April, the latest numbers we have, which was when the COVID lockdown were still in practice across a large number of the member states. So putting downside bias to the numbers. But most of the survey evidence still looks pretty positive. We had consumer confidence out of Eurozone, at least a flash estimate, just a short while ago. That was up at its highest level since January 2018, well above where we saw it was just before the pandemic actually struck, and a good deal higher above its long-run average. So taken at face value, sentiment within the household sector for the Eurozone is actually shaping up quite nicely at the moment. Indeed, it's been rising, for 5 months in a row now. We'll get updated PMIs, which I suppose if you're looking for the pick of the numbers as far as this week's concerned, we'll get the flash June PMIs tomorrow on Wednesday. They're expected to show a flash composite output index for the Eurozone as a whole of 58.8. That would be up a point or so from where we stood last time round, wholly reflecting a stronger services sector due to the ongoing easing we have of COVID restrictions at the moment. But, and I think we've mentioned this in the past, some of these PMIs for Europe have been, I guess, not as well correlated with the headline GDP numbers of late as we've become used to. In the past, they have had a pretty good track record for calling Eurozone GDP. And in particular, we've had the manufacturing PMIs really becoming increasingly optimistic in terms of what they think is going to happen to the actual hard data from manufacturing, which, if anything, have been disappointing, particularly coming out of a key German state, which has been making for, I suppose, a slightly more sluggish than expected recovery coming out of Eurozone goods production. But big picture stuff, I think, certainly as far as Eurozone is concerned at this stage anyways, that policy is probably going nowhere in a hurry. They really do want to see further evidence, hard evidence anyway, that the Eurozone economy is, the recovery is really starting to become fully entrenched. More interesting in some ways, certainly as far as central banks are going to be, is what the Bank of England's going to say. They'll be holding their June MPC meeting, the Monetary Policy Committee meeting, on Thursday. Now, certainly this time, I guess, just ahead of the last meeting, the general view was that BoE policy is really going nowhere in a hurry. Inflation's picked up a little bit, but just like the Fed and the ECB, they're still very concerned about the state of the labour market, so don't look for anything too soon. And indeed, probably in terms of the headline monetary policy levers, we're not going to see too much coming out on Thursday. But there has been been a fairly sharp acceleration in inflation in the UK, well above what we've been seeing coming out of some of the Eurozone countries. So the headline data for the May Consumer Price Index, which is the Bank of England's target variable, that jumped up from 1.6% to fully 2.1% in May. That was a good deal higher than expected by the markets, and also, I suspect, significantly above what the Bank of England was expecting as well. They've talked about inflation moving above target during the course of 2021, but I think this has come through rather sooner than anticipating. And more importantly, in many ways, the core index, which strips out the usual volatile items, that was up at 2%. So that's compared to 1.3% in April. So a 0.7 percentage point increase. That's one of the steepest increases we've seen on record. Now, yes, you've got some COVID base effects coming in here, but by and large, consumer prices in the UK weren't hit particularly hard by the COVID crisis last year. So it does appear to be the case that we're looking at a fairly sharp acceleration in underlying prices in the UK. Now, at the same time as we saw that, we saw a very strong labour market report, at least in terms of wages. The labour market is still behind where it was pre-pandemic days, but the turnaround is starting to come through and it's looking relatively buoyant now. And crucially, from the wages side, and yes, this is with the inevitable caveat of COVID effects on the base numbers from a year ago, but regular wages jumped up to annual growth of 5.6%. This is in the 3 months to April, and that's an all-time record high. So COVID or not, we're still talking some pretty chunky numbers here. And there are increasingly anecdotal surveys suggesting that there's a shortage now of skilled labourers in a number of areas of the UK economy. So it does look as if, to some extent, the pickup we've had in wages growth is a true reflection of the underlying picture. COVID will be making for some upside bias inevitably, but it does seem that there are generally rising price pressures happening in the UK now, both in terms of what's happening in the labour market, obviously what's happened in terms of raw material. We've got higher input costs pretty well everywhere at the moment, notwithstanding some pullback we've had of late in the likes of copper and lumber. And of course, demand is picking up very strongly as well. Now, the retail sales figures we had out of the UK back end of last week for May, they actually showed a fall, surprisingly, month on month. They were down 1.4%. These are volume numbers, but that came after an increase of over 9% in the previous month, which, in a nutshell, means that even if sales don't increase in June, the second quarter with volumes would still be up almost 12.5% above the first quarter. So, put all that little lot together, it really does suggest that UK second quarter GDP is going to be strong and probably stronger than originally expected. And that's reflected in Econoday's ECDI index, which shows a fairly consistent run now of stronger than expected economic numbers coming out of the UK. So it's going to be interesting what the bank does on Thursday. They won't change, I'm sure, the quantitative easing ceiling, which is currently at 895 billion sterling. They did reduce their purchase rate at the last meeting, but that doesn't mean anything in the sense that they're sticking with the current ceiling on just how much they can purchase in the first place. All they did last time was try to ensure that the actual purchase ceiling will be reached round about the end of this year, since that was their target date. And indeed, we'll almost certainly have to see some additional tapering between now and the end of the year to ensure that they don't actually meet that target date too soon. But in terms of the overall thrust of policy, quantitative easing, the ceiling remains at, or seems very likely to remain at, 895 billion pounds, and so long as that's the case, essentially we can say that QE isn't actually going anywhere. Interest rates are still going to be fixed at 0.1% for the foreseeable future, but markets now starting to at least contemplate the idea, because the UK economy apparently is doing so well, that we could see an actual interest rate hike coming through as early as 2022. Which would put the UK amongst the forefront of the major central banks anyway, in terms of raising interest rates, which should provide, of course, for a bullish backdrop as far as the pound's concerned. What else from my side? Not too much to say about the Swiss National Bank, which met last week. They met last Thursday. I guess the main thing to come out of that was that they reintroduced the term highly valued when they described the Swiss currency, the Swiss franc. That was previously dropped in March, when the Swiss franc had actually given back a fair bit of ground, with which the SNB would have been more than happy. But it started to strengthen a bit over the last couple of months or so. I think, as we talked about in previous podcasts, it has forced the SNB to intervene quite aggressively in the FX markets, selling the Swiss currency, to try and prevent additional upside potential. So something to keep an eye on there. But again, just really in terms of overall policy for the Swiss National Bank, nothing really there happening at all. Anything else from my side? Probably not really. It's a relatively quiet time in terms of the numbers. We'll focus very much on the PMIs tomorrow. Okay, Mr. Pender, anything else from you?
Yes. I was pondering what is limiting the Federal Reserve helping the lower income group. I guess the Fed, as a central bank, they're in charge of assets, and they can directly buying assets affect their prices. And we had existing home sales today, and that's very obvious that if you're a homeowner, you're enjoying a great ride of inflation that is increasing your wealth by a very substantial amount. Those who, however, and that's an asset. Those, however, who are outside that group are just seeing the idea, the hope of owning a home, just run away from them. If you look at the price, we had a slowing in home sales over the course of the beginning of the year after a great spike at the end of last year, and also into January this year. And the actual sales have been coming down, but not prices. Prices continue to climb. So, and that makes it, more and more out of reach for that group. And but what can the Fed do? Certainly, they can give lip service and all their announcements saying that, we realize that things are happening and we want to do the best, but maybe just because of the function of the structure of what the Federal Reserve can do, and again, the idea of monitoring or adjusting asset prices, that maybe what they can do for the lower income group is very limited. And anyway, so I just wanted to get that out.
Yeah, I think it's difficult, isn't it, for a central bank at the end of the day, just kind of intimating the policy responses they have available in their toolkit really tend to be relatively broad-based. I suppose you've got, from the way the ECB's been operating with its targeted repo operations, it's been looking at certain aspects of financial markets where there may be credit blockages and so on. But it comes, of course, the broad issue of interest rates and mortgage rates determining the ability of the would-be house buyer to actually buy a house because they've got to meet the repayments. So a difficult issue. And I guess it's something which we may see coming up more and more over coming months if we continue to see house prices rise. I think, as Brian was talking about the other day, we've seen some capital control ratios being introduced in New Zealand, which interestingly to me, I thought anyway, were actually, saw the government telling the central bank, look, they've got to do something about this and start to introduce some kind of limits on the amount you can borrow according to income and such like, to try and slow the market down. It may be perhaps we're going to have to see some kind of house market control, coming out of other countries as well. As you say,
and also about the idea of inflation, our instinct is that it's bad, but if you're in the stock market, if you own a house, if you're in Bitcoin or these elements, runaway inflation is a great avenue to a rising wealth. And I think the reverse is true if you're outside those assets.
Yeah, I think that's very true. Although it's got to be said, I wouldn't put too much faith in Bitcoin at the moment in the light of recent developments. So if you did buy it,
I take that back.
Good luck to you. Okay, right. Well, we done then? I guess we are. So let us wrap it up there. On behalf of Mark and myself, thanks as ever for listening. We'll be taking a week off next week, but please do tune in a week after that. And in any event, of course, the key market moving data and events can always be found listed and analysed in Econoday's global economic calendar. So we'll be seeing you early in July. Thanks for listening. Bye for now.